stock futures are showing minimal movement as we approach a significant inflation report, creating a sense of anticipation in the market. On Friday, the futures for the S&P 500 experienced a slight increase of 0.06%, while the Nasdaq 100 futures dipped by 0.1%. In contrast, futures associated with the Dow Jones Industrial Average saw a gain of 81 points, translating to a 0.2% rise. Investors are keenly awaiting the release of the Personal Consumption Expenditures (PCE) price index for August, which is set to be published today. This index is particularly important as it is the Federal Reserve's favored measure of inflation. Economists predict that the upcoming data will indicate a rise in inflation, and the markets are currently factoring in the likelihood of 2 quarter-point interest rate cuts in the Fed's forthcoming meetings, aligning with the central bank's own forecasts. However, the market's reaction could be influenced by this report, especially following the robust jobs data released on Thursday, which showed a significant drop in jobless claims. This data, coupled with a notable upward revision of the second quarter gross domestic product, GDP, to 3.8%, has somewhat tempered the bullish sentiment among investors. There is a growing concern that fewer jobless claims might suggest a resilient economy, potentially giving the Fed less incentive to lower interest rates. On Thursday, all 3 major US stock indexes experienced declines, while the yield on the 10-year Treasury note climbed to 4.2% at one point during the trading session, reflecting the impact of the latest economic indicators. In the realm of artificial intelligence, key players such as Oracle, Meta, and Tesla also saw their stock prices retreat. Oracle, in particular, faced a 5.6% drop, as some investors expressed worries that technology valuations have escalated too quickly, raising concerns about the overall stability of the interconnected AI sector. For the week so far, the S&P 500 has decreased by nearly 0.9%, while the tech-heavy Nasdaq composite has fallen by about 1.1%. The Dow Jones Industrial Average has also seen a decline of 0.8%. Despite these recent losses, some market participants remain cautious yet optimistic, looking for long-term investment opportunities. Andrew Sliman, who leads Applied Equity Advisors at Morgan Stanley Investment Management, mentioned that he would consider using any market weakness as a chance to increase his positions in technology stocks. The market was susceptible to a pullback, and since tech has been a leading sector, it is the most exposed. Sliman explained to CNBC, "I wouldn't panic over this market action. Any pullback or even a more significant decline in speculative stocks can be beneficial for the market's health. When speculation runs rampant, it often signals trouble in the long run." In other news, shares of Costco and Concentrix experienced notable movements following the release of their earnings results after the market closed on Thursday. Costco's stock fell approximately 0.9% after the warehouse giant reported its fiscal fourth quarter earnings and revenue that surpassed analysts' expectations, driven by impressive growth in both membership fees and its online sales. The company reported earnings of $5.87 per share on revenues of $86.16 billion, while analysts had anticipated earnings of $5.80 per share on revenues of $86.06 billion. Conversely, Concentrix's shares plummeted nearly 22% in after-hours trading, after the technology and services firm fell short of earnings expectations and revised its forecast downward. The company reported adjusted earnings of $2.78 per share, below the $2.87 per share that analysts had predicted, although its revenue of $2.48 billion did exceed the consensus estimate of $2.46 billion. Additionally, Concentrix announced an 8.2% increase in its quarterly dividend to 36 cents per share. In a related note, Tom Lee, the head of research at Fundstrat, shared his insights on the market's outlook, suggesting that even if the Federal Reserve opts for just one more rate cut this year, it could still be a positive sign for the markets. Lee indicated that if the Fed were to implement only one rate cut by the end of 2025, the markets might view this favorably, interpreting it as a sign that the Fed is cutting rates in a strong economic environment, rather than a weak one. His comments come in light of a slight adjustment in market expectations regarding a quarter-point rate cut from the Fed, following the release of lower-than-expected initial jobless claims on Thursday. We know that the Fed has been slow to ease due to the imputed shelter inflation, but the reality is they should have started easing sooner, Lee remarked. We need to be cautious. Just because it takes time for effects to manifest doesn't mean we should initiate a new cycle of rate hikes. I believe the markets will see through this situation. As we navigate these complex market dynamics, what are your thoughts? Do you believe the Fed's potential rate cuts will positively impact the economy? Or do you think they could lead to unforeseen consequences? Share your opinions in the comments.